You're listening to RPM, the podcast that explores the world of private markets. I'm your host, Graziella Scassillo, and today it is my pleasure to have here with me Ariel Goldblatt, partner, and Mark Tsang, managing director, both members of the private debt team. That will continue the discussion on market outlooks, this time for private debt market. Ariel, Mark, welcome to RPM.
Thank you, Graziella, for having us.
Yeah, thank you, Graziella. It's a pleasure to be on your podcast.
Ahead of us, an eventful year for sure. In our market outlook, you describe a landscape full of significant factors. We see COVID variants increasing their presence all over the world, the rise of inflation rate, the implementation of interventions, so monetary and fiscal policies. So regarding private debt in particular, is there something positive we can expect in all of this?
So yes, Graziella, I would say, private debt has shown resilience throughout the recent COVID period, as well as during the Great Financial Crisis. And what you'll see is that in both of these periods, private debt experienced significantly lower drawdowns relative to the public markets. For example, during COVID-19, direct lending experienced about a 5% drawdown versus 13 to 14% for the public high yield markets. In addition, if you look over a long period of time, take from 2006 to 2020, you will see that private debt returns have been quite stable in the 8 to 10% return range. If you were to compare this to the public markets, you would see significantly higher fluctuations in returns. Lastly, the public markets today are relatively expensive due to unprecedented monetary and fiscal stimulus, as you mentioned above, and as a result, on a relative basis, the yield differential between private and public markets has never been higher, with private markets currently generating between 300 to 400 bips more in yield versus the public markets today.
Just to add also to Ariel's points, private debt as an asset class has been very positive. It provides solutions to companies that have been and will be impacted by the trends you described around inflation, government intervention, monetary and fiscal policies. And what we see with opportunistic credit managers is that they're offering customized liquidity solutions to businesses, acting as essentially like collaborative capital to partner with them to help them trade through this period in the cycle. And what you see is, for example, private debt capital can work with the companies to transition away from reliance on government loans, tax breaks, repayment holidays. And as a result of this creates investment opportunities for the asset class.
Thanks both. So as you may know, we are lucky enough to have listeners from all over the world. So maybe they would appreciate also some regional overviews, maybe dividing the world in macro areas and talk about the strategies adopted in private debt for each of them.
Sure. Just to provide a framework, comparing the private debt markets across US, Europe, and Asia, an interesting way to look at it is to observe the market share of private debt versus banks in each of the regions. And that gives you a gauge of where private debt is in the life cycle for each of the regions. And so, for example, if you look at the US, you see private debt market share, roughly around 80%. And that compares against 50% in Europe and around 20% in Asia. So you can see the US is a much more mature market when it comes to private debt. And if you look at what happened during COVID impacting the economies in early 2020, private debt reacted very quickly within the US markets. And a lot of the debt funds with its capital were able to buy syndicated loans, high yield bonds at significant discounts. That opportunity set traded away, but due to how the market is set up, they were able to take advantage of that. And to a certain extent, Europe did likewise, but not to the scale undertaken in the US markets. And as this was happening, the managers then started to see there is an opportunity set here over the medium to long term where companies would be needing liquidity. So they quickly shifted towards fundraising. And what you see is a lot of new opportunistic funds being raised, parallel to a lot of the managers' core direct lending strategies. And this opportunity set was further accentuated by banks pulling back their lending. especially in the mid-market, and looking to support more of their larger corporate clients. So this further pushed the market share towards debt funds away from banks. And then if you look on the ground with CEOs and management teams, what you're seeing is an increasing sophistication and awareness of private debt products. And that is, again, reducing the reliance historically on banks. And then if I briefly then touch on Asia, again, similar dynamics in Asia where, a shift towards private debt away from banks during COVID. And, what you see in Asia was a little bit of bifurcation between Western markets and Asian markets, given the government's different approach to how to tackle COVID. And given the zero COVID policy, you saw a slightly quicker economic recovery in China and Asia at the beginning of COVID. And I think that stimulated some thought process in investors where they were thinking, actually, maybe it's quite important to get some sort of geographic diversification within our private debt portfolio, and hence a greater consideration about whether they should invest into Asia. And so again, this prompted more fundraising activity amongst Asian managers to have those conversations with investors. But again, a lot of difficulty around stringent travel restrictions as a result of the COVID policy. So what you saw was capital migrating to larger brand names within Asia.
Now, would you be so kind to introduce us to the current investment environment and to the different aspects compared to the pre-COVID one?
Of course. And what I'll do is I'll break this down into 4 categories. And the first category, which is most interesting, is pricing. And what we've seen is primary yields have largely gone back to pre-COVID levels. Yield compression continues, but it is less pronounced than in the public markets. And so what we've learned is that careful manager and strategy selection can counter yield compression by identifying niche strategies. The second area I will touch on is volumes. And now volumes have largely recovered from the COVID shock. However, there has been an increase in refinancing transactions as a result of a strong pickup in M&A. This has reduced the overall capital deployment in the market. The third metric I'll touch on is credit metrics. Now, there has been some deterioration in underwriting discipline, including on structure, covenants, borrower flexibility, which has been embedded in legal documentation. The trend is back to a borrower-friendly market. And then the last metric I'll touch on is borrower fundamentals. Overall, what we've seen is a strong recovery in borrowers, and what we've seen also is low default rates. And now I'll pass it on to Mark.
Thanks, Ariel. I think from the opportunistic credit side and kind of what the managers have been looking to invest in, there's a few things that we see. One is companies needing liquidity, having been impacted by COVID. So EBITDA is down, and obviously as a result of that, cash positions are down, respective to the capital structure that's in place. And then other areas are where companies maybe have fundamentally been impacted, and that revenues and EBITDA are going to be low, much lower than pre-COVID, and as a result, they need to reset their capital structure. And then you're seeing situations where there's disruption within a sector, and you see opportunities for consolidation, and companies being able to take advantage and acquire or buy competitors. All of this, needing capital that opportunistic managers can provide. And, these trends, very much revolve around corporates and companies. But, what we observe in this kind of COVID environment is that the need for liquidity extends beyond just corporates. We see that banks need liquidity, GPs, private equity and private debt GPs, as well as LPs. They're all looking for liquidity, and that could result in selling assets. And again, that creates investment opportunities as well. And we kind of anticipate this environment to kind of persist at least for the next 12 to 24 months.
Yeah. Moving now to the actual implementation of the investment, what would you suggest to navigate the transition?
Yeah, so our key focus area continues to be first and foremost to focus on diversification, not only to reduce concentration risk, but also to enhance deployment, income earned, and also to reduce reinvestment risk. The next thing we focus on is really being selective. Not all absolute yields will produce attractive risk-adjusted returns. And one thing that we always focus on StepStone on private debt is deployment. Deployment is key. So strategies consistent with capital deployment are attractive, such as traditional senior lending. In addition, a multi-strategy and multi-GP approach can help maintain efficient capital deployment. In addition, use of co-investments and secondaries can also further enhance your deployment and diversification. And then lastly, I would say maintain flexibility in terms of GPs, strategies, etc. In a more complex investment environment, flexibility really is key.
And I'd definitely like to reiterate, Ariel's points around flexibility being key, and that's kind of the way the private debt platform at StepStone is set up. It's very relevant for opportunistic strategies, and the key part around flexibility is that we cannot predict for sure, when market dislocations occur or when an opportunity set arises. So the platform is set up such that we can move our clients' capital towards opportunity sets as and when they arise. So say, for example, if there's a dislocation in public secondary markets, we have vehicles that can then deploy capital into that opportunity set. For example, if banks suddenly need to sell assets off their balance sheet, again, we have vehicles and managers that can deploy into that opportunity set. And equally, if we observe, private equity needing additional capital to cure some of their portfolio investments or to grow their portfolio investments, again, we have the ability to deploy into that. So I think kind of within opportunistic, having that flexibility that is really crucial to be able to anticipate opportunity sets when they arise.
Thanks to both of you.
Thank you very much for having us, Graziella.
Yeah, Graziella, it was really nice to be a part of this.
Thanks for listening. If you enjoyed this episode or wish to listen to any of our other market outlooks, please visit our show page at www.stepstonegroup.com. RPM is also available on Apple Podcasts, Spotify, Stitcher, or wherever you get your podcasts.